Thank you for joining us for another My Wealth webinar. Today's really exciting. We have ICM Asset Management with us. They'll be discussing their Crescendo Music Royalty Fund, which is a very unique, uncorrelated strategy that has had some very attractive returns. For those who don't know me, my name is Jeff Hunter. I'm a senior portfolio manager with the Townshend, Somani and Hunter Group at Canaccord Genuity. Also on the line are our lead investment advisors, Dave Townsend and Raheem Somani. For more information about our team, our process, visit mywealthmanager.ca. Well, Mike, I appreciate you coming on and sharing us your strategy. It's pretty interesting because not too many things come to mind when I'm sitting in my car listening to a song I may or may not like, but also have the ability to make some income from that. I think of the Taylor Swift catalog that you picked on. Actually, my daughter's favorite song that has been on repeat for the last 3 months, The Middle by Zedd and Marion Morris, has been on in our car a lot, and I'm sure it's helped a little bit in terms of returns. But can you just tell me more about yourself, your company, and this unique strategy that has done so well over the last few years?
Yeah, thanks for having me. So my name is Michael Baker. I'm one of the principals at a firm called ICM Asset Management. We are actually a local Calgary-based business, and effectively we are an alternative asset manager. So we manage capital on behalf of retail portfolio managers, independent portfolio managers, family offices, institutional groups, private equity funds, and everything in between. And we manage assets purely on a private alternatives basis, meaning that we do not run any strategies focused in public markets. And all of our different business lines. So right now we've got a real estate business, we've got a credit business, we've got a music royalties business, we've got a venture capital business, and obviously those are all private asset in nature. So kind of the thesis of today's discussion is going to be, more geared towards our music royalty investment platform, which is super interesting, something that we launched back in 2020. So we're coming up on 5 years of running the mandate, and obviously a highly unique asset class with very little correlation to other components of portfolio construction. And since then, we've scaled the platform to now have Canada's largest open-ended evergreen music royalties fund. So happy to kind of dive in and talk about the platform a little bit more, but didn't know if you had an agenda prior.
No, this is good. I think the major part is, how do you make money from this? What has the experience been like? We had the Deadpool movie come out, and all of a sudden, Bye Bye Bye, which is one of your songs that you guys own. How does that benefit you and all the shareholders within the fund?
Yeah. Okay. So why don't we do this? Why don't I share my screen and I'll kind of walk everybody through kind of the fundamental principles of the asset class and how it works. And hopefully we can keep this as conversational as possible. If anybody has questions, comments, anything, feel free to chime in. I think there's probably a chat box to be able to drop things in. So just give me 2 seconds and I'll share my screen. I think this will start to make a little bit more sense for some people. So just give me a nod there when the screen sharing is working.
Good.
There we go. Okay, so like I said, look, I mean, the fundamental principle of why this is an investable asset class is that music has to be licensed. Okay, that's not an ICM rule. That's a law. So the way you should think about that is that regardless of where you're hearing music in our ecosystem, whether that be through a traditional music streaming service like a Spotify or an Apple Music, whether that be through a social media app like TikTok or Facebook or Instagram, whether that be through a connected fitness platform like Peloton, or movies, TV shows, radio, live performance, you name it. If you're hearing a song, whoever owns that underlying intellectual property is being paid a royalty for its use. So that's the fundamental principle. And really what that means is that all of these different artists, creators, publishers, vocal coaches own what are called catalogs of their work. Okay. So if Jeff, let's use you as an example. If you're the lead singer of a band and you were to go out and write and record an album and upload it into the ecosystem, you're going to earn revenue every time your titles are used. Okay. You can literally earn fractions and fractions of a penny for each play. And so what that means is that all of these different industry players own their own catalog. And our business model is very simple. We effectively acquire other people's catalogs by paying a multiple on the trailing cash flow, and then we own them forever. That's what we do. So it's a really simple business model. There's very little moving parts, and the end result for investors of the strategy is that they own a piece of a highly diversified portfolio that owns dozens and dozens and dozens of artists across over 4,000 pieces of intellectual property. And the end result is that they have an income stream and a total return profile which is generated without having correlation to any other components of portfolio construction. And these are extremely long-lasting assets. So the way that this works, and again, this is a law, not an ICM thing. Before music becomes public domain, the owner of that underlying intellectual property collects royalties for the life of the artist plus 70 years, 70. So again, the end result after we do an acquisition is that we own an asset which will have far in excess of 100 years of usable life and will pay a regular cash flow stream based on the usage of that asset. And unlike other components of portfolio construction, there's very little moving parts in the music royalties business because there are no incremental capital costs. And what I mean by that is that you effectively own an asset where your top line revenues equal your bottom line cash flow. So once we've deployed capital into acquiring these catalogs, we have to do very little, right? Somebody else is generating the revenue. Somebody else has set the royalty rates. Somebody else is going to administer and pay us the royalties. And we never have to put another dollar into these assets. So again, to my point, you own a 100-year asset, 100-plus-year asset, where your revenues equal your cash flow. And that seems like a pretty resilient and durable business model for us.
How do you come about these relationships where you can get access to some of these songs? Like, you're not just having songs from, the fringe. A lot of these ones are pretty mainstream and public. What's the philosophy? What age of songs do you guys typically look for? Like, are you looking for the things that just came out and hit the billboards? Are you looking for things that have aged a little bit? Are you looking for things that have aged a lot? Where's your sweet spot, and how do you guys, one, get access to these catalogs, and narrow it down to your niche?
Yeah, so the access side is really the bread and butter of what we do, right? I mean, without deal flow, you have no fund. So we do have a network of advisory relationships that are highly connected in the music space. These would be, Grammy award-winning artists, producers. These could be large-scale legal advisors in the music entertainment space in Nashville, LA, New York, et cetera. But we actually get a lot of deal flow sent to us. And the reason for that is that we would be considered, call it mid-market, meaning we're not going to compete on a $200 million transaction where the large institutional players are heavily investing in the space. Our sweet spot is doing deals that are $5 million, $10 million, $15 million at a time. And the reality is that there are just not that many buyers of a $10 million catalog. And as a byproduct, we get a ton of deal flow sent to us. So our pipeline of deployable capital is significantly larger than we could ever hope to close on. And your question on kind of what we're targeting or what we're buying, there's a few things that I would point to. I mean, first and foremost, what we buy has to be reasonably iconic. And when I say reasonably iconic, I mean that we want to be buying or partnering with artists that will exist in the future, right? So you don't really want to go out and buy some, even if the economics of the deal look really great, you don't really want to go out and buy stuff from an artist that might not be relevant in 50 years. So the commonalities between all of the deals that we've done are, and maybe I'll flip ahead and I'll show you kind of some examples, but we want to build a reasonably well-diversified portfolio spread across multiple ages, multiple eras, multiple genres. And we've done things, we've done acquisitions everywhere from, Five Finger Death Punch and Disturbed on the heavy metal side, right to classical violinists and country. We've done deals in hip hop, rap, pop, folk, and even Christian music and Christmas music. We've done stuff in basically every genre. So again, the end result is that we have a portfolio of over 4,000 pieces of intellectual property spread across basically every diversification metric that you could think of. But all of these acquisitions are similar in one way. And it's that the profile of the deal looks reasonably similar from an economics perspective. And typically when we're deploying capital, we want to do so in a way that looks a little bit like this. So this is a kind of a highly dumbed down version of how you should look at it. But this green line is illustrative of a profile of a catalog that we would be interested in, meaning there's not high variance or high volatility in the consumption. And we typically want to buy something that's a little bit older. And what I mean by older is that we don't want to buy anything that is brand new and unproven. Our business model is much more focused on deploying capital by simply paying a multiple on the trailing cash flow to acquire these assets that will last forever. So you can see here that if I flip ahead, our current portfolio construction is not only diversified by genre, but if you look at the age side of things, this is highly important. And again, really what this means is that we don't want to own anything that's new. You can see that effectively none of the portfolio is between 0 and 2 years old. That's by design, right? We want when something's a little bit older, it has more data or more predictability for us to be able to look back at and pay an appropriate multiple, if that makes sense.
Absolutely.
Mike, a question here. You're buying songs that have enduring value. Some artists face renaissances and their songs are revitalized. How do you come across that, or how is the music utilized by various groups from like Peloton to movies, etc.? Who do they negotiate with? Do they come to ICM? Is there a representative that ICM uses that an entity can negotiate with? I'm just looking at understanding how the predictability is fantastic because that drives constant revenue. And now I'm looking at, how does an artist within your portfolio grow when you own all the rights already?
Yeah, so in many cases, we actually decide and strategically don't want to own all the rights. So when we buy a catalog, we are completely okay buying partial pieces of catalogs in which the artist retains an interest. At the end of the day, they are the only ones that can really move the needle in terms of promoting their own work. But really what happens here, Raheem, is that streaming revenue is the baseline. So when we're looking to pay a multiple on the trailing cash flow, we assign almost no value to anything that's not streaming, because streaming is predictable, streaming is reoccurring, streaming has a revenue source that everybody pays on a monthly basis. So the way you should think about how the ecosystem works, and I'll answer the second part of your question in a moment here, but this is, again, kind of a dumbed down way to think about it. But think about for every dollar that's generated in the music space, whether that be through subscription price or ad supported revenue, et cetera, the platforms themselves keep about 30% of it. So that 30% goes to the Spotifys and the Apple Musics of the world, and about 70% flows down to the rights holders. So if you put two and two together, what that means is that we have some serious secular tailwinds that are helping our cash flow streams grow over time by the actions of others. So if Spotify goes out and raises prices by $1, well, our cash flows increase. If Spotify goes out and launches their services into some emerging markets, which have not been penetrated yet, our cash flows increase. As new platforms come to market that start generating revenue that didn't generate revenue before, think about like a TikTok, for example, our cash flows increase. So that's on the music streaming side of things. And again, going back to this chart, this is where we assign almost all of the value, is in the reoccurring streaming revenue that's predictable. Now, your question was more on what's called sync, and sync licensing basically means when you're pairing music with video. And sync licensing, if you own the copyrights, you have to give permission for that to be used. In 99% of cases, we would always say, yes, you're free to use it. You don't really want to get involved in maybe the political aspect of things, et cetera. But for the most part, like if the big players are coming to you, and largely this is all administered through the big three, which is Sony, Universal, and Warner. If people are interested in putting our intellectual property into sync licensing agreements, generally speaking, we say yes. And that's things like movies. I mean, Jeff, you referenced the big spike that we had from owning Bye 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 going into the Deadpool movie this year. That could be through commercials, TV shows, everything in between. So we don't really assign a whole lot of value. And typically what happens is that when something does get put into a sync license, so it's, goes into a Super Bowl commercial, goes into a movie, whatever that may be, is that you get this really immediate spike in usage because people hear the music through the commercial, then they go and consume the music on a streaming service app. And then eventually over time, you just revert back to the mean. So again, when we talk about not wanting to pay a multiple on the non-reoccurring cash flows, it means that if we're looking at a catalog that 50% of their revenue in the last 3 years was driven from the fact that they were put in a commercial, well, that's not of interest to us to pay a multiple on because that's not reoccurring.
And some of the, looking at some of the biggest private equity firms in the world and institutions have moved very heavily into this space. Kind of speaks to the economics and the opportunity here. And this is why we really are intrigued and looking at this fund as a opportunity for investors to capitalize on what I believe is still early days in the royalty streaming business. Now, most people will be familiar with oil and gas royalties, mining royalties, but this is a very fascinating area where you're not working on a depleting asset, but you have a fixed asset that can continue to pump cash flow, as you said, almost forever. So just in terms of the market size, how big do you anticipate your catalog to get by way of more investors joining the fund? Like where would you feel very comfortable of marching this sort of portfolio to a number of, as you would call it, artists?
Yeah. So we've already done, almost a couple $100 million worth of transactions. We have some pretty meaningful scale in what we're doing. Now, when we talk about how big we could get, it's going to be dictated on one thing and one thing only: our ability to deploy capital at an appropriate multiple. So, again, using kind of round numbers here, we've deployed the portfolio at approximately 11 times trailing cash flow to date. And given that these cash flow streams have slightly grown over time due to the kind of industry tailwinds, our payback on these assets are about 9.5 years. So to your question, how big do we want to get? We want to get as large as we can when we can still find deal flow to be able to deploy that capital at an attractive multiple. When we can no longer do that, then we will have to reconsider whether or not the fund will continue to grow to X scale. But again, like this is a highly underpenetrated market, even though almost every major institutional player you can think of is investing into this asset class. Call it in the high 90% of global catalogs are still in the hands of private individuals. Very different than more well-established industries like real estate, for example, where large funds tend to make up large portions of ownership, if that makes sense.
Do you see a risk at one of these institutions just saying, hey, I love your catalogs, I love what you've done here, we just want to buy the whole thing?
Well, I mean, I wouldn't say that's necessarily a risk. Certainly,
Positive risk, but
what's that?
positive risk nevertheless.
Positive, yeah, positive risk, yeah.
There are
No, yeah,
those in life.
yeah, but those conversations will, without a doubt, happen. I mean, look, the smart institutional money is exactly that. They're smart. If they can find a way to deploy capital in a way that delivers an attractive return and provides a correlation benefit to their overall portfolio construction and help matches with their kind of cash flow liabilities, they're going to come, and they are coming, right? So and everybody from Blackstone to KKR to Apollo, PIMCO, Brookfield, Partners Group, like if they're a big private equity or endowment fund manager, chances are they've either deployed capital in this space or they are highly looking at this space. So I have no doubt in my mind that that will continue to happen. And really our sweet spot, again, just to reiterate, is that the large institutional players have to deploy capital in such large tranches that the massive catalogs get bid up in price. So if you're, we would have no ability to have deployed capital at 11 times trailing cash flow like we have if we were trying to deploy capital at $200 million at a time, because the competition at the top end of the market is highly, highly fierce. And we have much less competition in, call it, the mid-market size catalog. So we're happy to just continue to do as many $5 and $10 million transactions that are accretive to the portfolio as we can.
Now, with the income on there, how do you decipher when you make distributions? Is this something to look for distributions from, or is this a reinvested strategy because of the opportunities?
Yeah, so the fund itself pays a fixed distribution yield, and the fixed distribution yield is dictated by one thing and one thing only, which is the income that's being generated by the underlying pool of assets. So we pay a consistent monthly distribution to our investors. Investors obviously have the option to reinvest distributions. In fact, when they reinvest distributions, they would do so at a 3% discount to the current NAV. That makes it easier for cash management on our side. But for investors that just want a regular monthly income, they can just take a regular monthly income. So this is an open-ended evergreen trust structure. And as a Canadian trust, we, as many of you know, will have no ability to retain income or retain earnings in the trust. So we have to flow all of those through proportionately to the unit holders.
So with that, can you just talk about the structure of it, fees, eligibility, it being RSP eligible, kind of time frame of owning the fund, if there's any short-term liquidity costs or the sort?
Yep. Yeah. So it's like I said, it's an evergreen trust structure, which means that it's eligible for all account types. It can be held in registered accounts. It can be held in corporate accounts. It can be held in open accounts, in trust accounts, whatever it may be. The pricing and distributions and capital happens on a monthly basis. Redemptions also happen on a monthly basis, but the caveat to note there is that there's a 6-month soft lock, which would basically penalize somebody for ownership less than 6 months to the tune of 5%. And that's basically just to disincentivize anybody from short-term holding the instrument. Now, again, like let's not lose sight of the fact that you should always match your time horizon of your committed capital to the time horizon of the asset. So when we're attracting capital here, for the most part, we're looking for permanent capital, right? These are perpetuity assets, and as such, we are holding it in a perpetuity structure and are looking for perpetuity investors.
Perfect. Raheem, Dave?
Yeah, just a follow-up question, and then I think we can just march through the presentation, any pertinent points. But ICM principals, directors, employees are investors in their own strategies. do you want to highlight, your involvement and the principals? We know a lot of them. You guys are definitely one of the top groups in Canada now, but the best stewards of capital are those that invest in their own strategies. So are you able to highlight that a little bit?
We all invest in our own strategies, and as owners of the business, I mean, it's highly important to note that we are incentivized shoulder to shoulder with our clients. I mean, at the end of the day, I think it's, without disclosing figures, it's pretty reasonable to say that most of the partners at ICM have the majority of their liquid net capital tied up in either the ownership of ICM directly or underlying investments in the entities, and that's extremely important for us.
Perfect. Any other topics or things you want to point out within the fund?
No, I mean, I think there's a lot of moving components with respect to like fully understanding IP law and kind of how this business works. But I think that's kind of the idea here, is that like this is an asset class that is not accessible outside of having sophisticated management to do so, right? That if I showed you the administration that happens behind the scenes where we're getting these payments and we're getting statements of royalties associated with them, no exaggeration, we're getting statements that have millions and millions of line items breaking out each individual play, its incremental dollar revenue, and then we have to track that back to the consumption, which we can kind of watch the music consumption data in real time and kind of administer all that through into a fund structure. So there's a lot of moving parts that go on behind the scenes. But if you, again, not lose sight of the fact that when you boil this down to a very simple economic model of the fund, there's not a lot of moving parts here, right? Again, you own a perpetuity asset that never requires you to put an additional dollar of capital expenditure into it, and cash flows are just simply flowed through to the underlying investors.
Great.
Yeah, no, this looks very exciting. I think when you think about the world of investing, it opens up the opportunity bank. It opens up the set opportunities, ideas. We're thinking infrastructure, we're thinking farmland, we're thinking private real estate. There are so many other potential portfolio enhancement strategies. And I think when I look at the whole idea of streaming and royalties, to a point, a recession doesn't look like it would heavily impact our level of listening capacity. It may actually increase it in so many ways. So, when I see the opportunity here, it looks very attractive, and I think it definitely leads and allows us and clients of ours and new clients of ours to participate. So, we appreciate ICM putting this together and allowing investors, especially at a retail level, to take advantage of something that's is pretty familiar to all of us, and now kind of understanding where the financials and the business side of it can really add to an investment return. So that's good for me.
And Raheem, you maybe just one last point. You brought up a good comment there about kind of the resiliency, and again, let's not lose sight of the fact that all of this revenue is generally derived either from ad-supported revenue or subscription service revenue, right? And on the subscription service side, you're talking about a very low basis. And what I mean by that is that these payments have largely become ingrained in our society, and the staying power or the stickiness of the payments is extremely high, right? So if a recession hits, are you gonna cut the $9 a month to save on Apple Music? Probably not. There's probably other areas of your life where you cut spending first, which are the more cyclical parts of our industry, right? Think dining and travel and all of those things. But in some ways, there's a pretty good case to be made that for $9 a month, this is the absolute best bang for your buck, right? You're getting access to unlimited content and unlimited music across the globe for one subscription price. And the same thing holds true with revenue growth, right? So the way you should think about that is that these platforms have incredible pricing power because they're compounding off of such low basis. So if Spotify sends out an email like they do periodically, so to the benefit of the fund investors, that says, hey, your subscription price is going up by $1 starting next month. Are people going to cancel their subscription because it now costs $12.99 instead of $11.99? Probably not. But on a percentage basis, that's meaningful, right? If you're talking about a 10% price increase, think about a 10% price increase off of a basis in a component of our lifestyle that's much larger. Think rent, right? Like landlords' ability to raise rent by 10, 20, 30% in one single tranche, no chance, right?
Well, with that, anyone on the call that wants to talk a little bit further, feel free to call me, Raheem or Dave. More than happy to discuss further. Michael, really appreciate your time. I think this is a very fascinating, evolving asset, and it's just there's not too many things like it, and music is ingrained in our culture, and in every culture really, in that matter. So it's something that that's not going to be going anywhere. So thank you for your time, everyone that shared your lunch hour with us, and we'll talk to you soon.
Thanks, Michael.
You're most welcome. Thanks for having me.
Thank you.